Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is October 7th of 2024. Really the first full update of the fourth quarter. And we're certainly glad you can join. I hope that everyone had a great weekend. We got a lot to talk about. Certainly some very noisy events that are taking place in the Middle East right now as it relates to geopolitical risk, that ongoing confrontation, not just really between Israel and Hezbollah, but also between Israel and Iran. That said, what we're really going to focus on this week is the stuff that really matters to stocks, because that's what we get paid to do. And we're going to focus on the biggest thing that moves the needle for the markets, at least historically, which is, of course, U.S. economic leadership and the health of the U.S. economic engine. So these are going to be the things that we focus on. Now, one thing aside from the U.S., or not the U.S., but from the Israel-Iran confrontation that took place last week was the U.S. jobs report. That was the big news in our world, right? And so the title of this week's presentation is The American Job Surge. So really after months of slowing growth as it relates to just the general economy and also slowing employment growth, we saw a surge in the month of September. And this isn't the first economic report that has shown strength as of late. We're starting to see a pattern of beaten raises by not just companies, but economic reports, right? We're starting to see employment pick up. We're starting to see ISM services, so in other words, service level activity pick up across the US. So we want to understand what all of this means, not just for us as portfolio managers, but for our advisors' clients. So 3 big things this week. We're going to do an employment update for September. What do the numbers show us? What does it mean? A stock market health check, go through the internals, go through breadth, look at some of the long-term trends versus momentum. And then lastly, look at market seasonality and some of the key takeaways from last week's events. So in terms of the employment report, it was a big one. I mean, we came in at 254,000 new jobs that were created in the month of September. That is nothing to scoff at. That was the highest number since March of 2024. So this is important because what it does is that it really changes the calculus and the thought process around, are we going into a recession or a soft landing? So we want to pay attention to that. July and August numbers were revised up by 72,000 jobs, and the average hourly earnings was up 4% year over year, which is up from 3.8%. Now, this is important. So average hourly earnings swung up while inflation swung down. So that's potentially what you're seeing is this type of Goldilocks setup that's beginning to take place. So rates came down, average hourly earnings went up, and inflation came back down. So this likely does push that second rate cut to December, and that's okay, right? So we did see a little bit of rhetoric around, okay, well, strong economic data is potentially bad for stocks because you push off additional rate cuts into December. Ladies and gentlemen, let's not overcomplicate our life. That's something that I've been guilty of in the past. And at the end of the day, what does a strong jobs report mean? It is very suggestive of no recession, right? And the number one killer of bull markets are recessions. So in our opinion, if a strong jobs report is suggestive of no recessions, that's just good for stocks, right? The more that you can put off recession risk, the more you can lower it and push it off into the future, that's a good thing, right? Recessions are not good. That's not a good reason to bring down interest rates, right? Remember we talked about last week, interest rates coming down can be good or bad for stocks. It's good if it's accompanied by a soft landing and reacceleration. It's really bad if it's accompanied by a recession. This jobs report suggests we're in the former camp, right? That we're in this camp of lowering rates and accompanied by a soft landing and or reacceleration. So don't overthink this. Recessions are bad for stocks and expansions are good. Obviously, the historical numbers will back that up quite strongly. So the economy reaccelerating. So I want to show this chart here. This is the red line is what we call the economic surprise index. Okay, this line moves up when economic reports are beating expectations and moves down when economic reports are coming in worse than expected. So how does this mean? What does this mean for stocks? I think the best way to use this chart is whenever you get to an extreme, if this chart is way up at a 52-week high, you might start to see where economic forecasters are getting a little bit too bullish and the economy starts to disappoint a little bit. Versus when it gets down here, it's no different than stocks. Economic forecasters get too pessimistic. And guess what? You have a lower hurdle to cross in terms of those economic reports, and we start to beat expectations. So I think that's a good thing, right? So what this means is when we talk about this soft landing or hard landing, it reduces the risk of the hard landing. Okay, so we're in the soft landing, which equals no recession. And if that's the case, is the next step liftoff, right? In other words, the economy reaccelerating to the upside. Now, as it relates to market conditions, the long-term trends remain strong. And there's a common rule that you don't short a strong trending market, right? You just don't do it. Does that mean that that if you short a stock in a strong trending market, you can't make money? Of course not. That's not what I'm saying. But if you're playing the odds and you're in a strong trending market where 70% of stocks, currently 76% of stocks, are trading above their 200-day moving average, that's a healthy market. The only blemish really is that the percentage of stocks at 20-day highs is fairly low. So what that says to us is that you have a strong long-term trending market backed by strong secular tailwinds, but short-term momentum is a little bit weak. And why is that? We had a really strong rally in the second and third week of September, and investors are sort of asking a little bit of, okay, what's next? We got the rate cut. Now what? Well, we had some weakness in the first part of last week, and then we got the now what, which was that strong jobs report. And the market was, if you paid attention to the action of the market on Friday, it was up, it was down a little bit, it was flat, it tried to rally, and then toward the end of the day, it really rallied, right? And that's what you want to see is this debate with a strong finish into the close of the market. So that's something that we really liked in terms of how we closed out last week. So what does all of this mean? In summary, the jobs report likely lowers the risk of a recession, defers the next rate cut into December. And I think really at the end of the day, we want to embrace stocks and economically sensitive asset classes, right? So those asset classes that can do well during expansions and outperform historically during expansions. Last thing I'll leave everyone with, of course, is, and we've shown this slide before, but I do want to reiterate this, is that we are entering a period of what is considered historically a strong seasonal period for stocks. Again, we don't know why, but the odds do go up even in this seasonally strong period when you've had a strong first half of the year, right? So from January to the end of June, we had a very strong market. We were up 14.7%, okay? So at the end of the day, when you have that type of strength in the first half of the year, the second half of the year, we've averaged 9.8%. So in other words, a strong finish. And really the only reason why you don't see those returns match that 14% or some of the first half numbers is that September, back end of August, first part of October tends to be seasonally weak. So bottom line here is when the first half of the year has market performance of greater than 10%, and we had 14.7% this time around, historically, the back half of the year, 83% of the time, when you've had these conditions, the market is up. So is that a guarantee that we're going to get positive performance between now and the end of the year? It's not. Market's already up quite a bit for the year, right? So you could definitely get a retracement. But what it is suggestive of is that the odds are on our side. That's all we're saying. So from a seasonality perspective, we like where things stand. So bottom line, ladies and gentlemen, very strong jobs report. It was very healthy. You had strong wage gains across the board, and inflation back in August was low. So you had this nice setup of real wage gains expanding. So that increases the prospect for stocks, at least between now and the end of the year, in our opinion. Number two, falling prices by plus accelerating growth. We think that potentially leads to Goldilocks, Goldilocks setup. And of course, in this type of environment, we prefer high beta and growth over low beta and values. So that's what we got for you this week. 888-543-3776. Please let us know if you have any questions whatsoever. Please reach out to your advisor. We're here to help, and have an absolutely fantastic week. Thank you.